The company reporting strong quarterly results with second quarter profit jumping nearly 60%, with cargo volume up more than 20% when you compare it to the same period last year. The company earned $2.72 a share on $5.5 billion in revenue. Let's bring in Lance Fritz, who is Union Pacific Chairman, CEO, and President. We've also got Yahoo Finance's Adam Shapiro joining in on the conversation. Lance, it's always good to talk to you. A strong quarter across the board here, but I'd love to just start by talking to you about where things stand right now, because you've got the good news, volumes picking up, things picking up, and yet you've got the massive backlog that's happening at ports that's really slowing things down for you.
Yeah, Akiko, thank you for recognizing a record quarter. I'm very, very proud of our team. So let's get into that. Your question's really about international intermodal total supply chain, and that's been strained for some time on the strong growth of demand from U.S. consumers for imported goods. It started out, if you recall, there was a backlog of ships trying to get on the West Coast ports, and we helped by putting many more resources, increasing the amount of train starts that were taking boxes off the ports. And so we helped kind of alleviate some of that pressure. The problem is all those containers went inland, and in places like Chicago, we have the ultimate shipper having a hard time getting the box off our ramp and into their distribution center or warehouse. So we've been helping there as well. We've opened up additional capacity to hold more boxes. We're helping that beneficial cargo owner community find additional dray opportunity to take the boxes off. But it's a tough go. Fundamentally, you've got demand outstripping the supply of capacity to take boxes from the ramps into the distribution centers.
Lance, it's Adam. Congratulations on the quarter. Let's give some of the metrics that investors like to pay attention to, especially with railroads. I won't pretend to truly understand it, but I know that the operating ratio is key to measure the profitability and efficiency of a railroad. And your number, 55.1%, is truly an incredible number to hit. But then you look at some of the revenue picture, and I was listening to the earnings call. Bulk commodity revenue up 19%, industrial revenue up 24%, premium revenue up 50%. And then it was pointed out, automotive alone within the premium unit was up 119%, would have been higher without the semiconductor shortage. Where I'm going with all of this is it was an incredible quarter for the railroad, but how do you sustain that going into the third quarter and the fourth quarter?
Yeah, it's a great question, Adam. I also want to point out that our favorable comparisons in terms of how we ran the railroad weren't just good from 2020 to 2021. They were good from 2019 to 2021. We made more operating income, more EPS on slightly lower volume in the 2-year period. And to your question, what made the quarter great was that we pulled all three levers that moved the numbers at the same time. It's a good pricing environment, and our commercial team did a great job translating the service product into value for customers and receiving price for it. We did a good job generating productivity. It was about $130 million in the quarter. And we saw volume grow, as you point out, and it also grew sequentially from the first quarter. As we look into the next half, we still see productivity. We've committed that we're going to see about $500 million in total productivity, and I think we're standing in the neighborhood of about halfway there through the first half. We committed that we still think there's pricing opportunity, that demand still looks good. Although, Adam, there's a few headwinds on demand, and it's not about slowdown, it's about comparisons becoming more difficult. We shipped the heck out of grain in the second half of last year, so that's a tough comparison. And we've also had really strong e-commerce intermodal demand all through the second half of last year. We think that keeps up. It's hard to really grow off that base substantially. But, you know, being able to generate overall a 200 basis point improvement in our margins and our operating ratio for the year, that means the rest of the year has to be in the ballpark of as good as the second quarter, and we're confident it's going to be.
I think the guidance for full year growth was 7% with free cash flow around $7 billion. But when I was listening to the earnings call, and it was a truly strong quarter, what stood out to me was what you've already talked about with Akiko, with some of the intermodal problems internationally, but also things that are beyond your control. I'm talking about the climate. I mean, a fire destroyed one of the bridges that you're now rebuilding in the Northwest. How much of an impact is climate having on your ability to go forward?
Climate has a real impact on us right now, and it shows up mostly in the form of severe weather spread around the railroad and with greater circumstance or greater impact on the railroad. Take that bridge that you pointed out. That bridge is about a quarter of a mile long. We lost it in the very early part of July, and we probably don't get it back until, call it, the second half of August. The beauty of our network, our franchise, is that we have alternative route. But that doesn't come without a cost, right? We have to put more locomotives, more employees into the network to be able to do that. And it's also at a service product that adds a couple of days to the shipments on the West Coast from north to south and vice versa. But you're exactly right, Adam. Our commitment to reducing our footprint when it comes to greenhouse gases and doing our part on global warming is also self-help to a degree, because global warming has a real impact on us.
Yeah, and Lance, it's Zack here. Just wanted to follow on Adam's question around the worker shortage we're seeing in shipping. Some of your competitors also dealing with that. I mean, how much stress does that add maybe the back half of the year? As you pointed out, 7% growth, the forecasting there looking good. But how much uncertainty is there in making sure you're going to have the staffing to make it all happen? What do you see in terms of maybe incentives you might need to add?
Yeah, Zack, what we said this morning on the call was that we expect growth through the second half of the year, but we also expect our overall headcount, which is about 30,000 people right now, to stay about flat. I'd love nothing more than for that growth to demand that we put more people to work. And we're not really seeing an extremely difficult time hiring new employees. We've had to hire for attrition and for a couple of different pockets of demand. And there are some locations like Los Angeles where it's a little harder than it has historically been. But we've still got a fair number of people who are furloughed, and we're calling them back into the network as we need people. And they're returning at about 70%. That's because our jobs pay awesome. They got great benefits. And you're building America when you work for Union Pacific. So the work has meaning.
Just want to wrap up with the political news when President Biden signed that executive order. We've had executives from trade organizations representing the railroads talk about the impact it could have negatively on the balance sheets for railroads. What do you think? And I think it's this issue of reciprocal transfer. Would that truly impact a railroad like Union Pacific?
Yeah, let's start at the top. The executive order does have an impact. The railroads, we perform a critical function in the economy. We ship really big stuff, bulky stuff, really efficiently. We provide high-paying union jobs. We help other companies reach their greenhouse gas targets by taking trucks off the highway, and we pay for it all ourselves, right? We build our own infrastructure. The EO kind of goes against our ability to do some of those things that also help directly the administration's effort on greenhouse gases, on decongesting the networks of our highways, on infrastructure spend. So we're trying to help all of the administration understand that. When you ask specifically about reciprocal switching, it's really about forced open access. And forced open access puts cars where there isn't capacity. It rearranges the transportation plan from one that's efficient, sound, provides really good, reliable service to one that can be disrupted pretty easily by the whim of one or two customers. And it basically benefits a small number of customers and it hurts the overall service product for all other customers. We think it's a bad idea, and we've been talking with the STB about it for a long, long time, and we'll keep those conversations up.